Hello, this is Dr. Kabiawu, and welcome to the lecture on inventory measurements. This is Chapter 8 of Intermediate Accounting Textbook by Spiceland, and we are working with the 9th edition. We're going to start the chapter with an overview of what inventory is, and then we'll go on to talk about the costs that are capitalized in inventory on a company's balance sheet. Inventory refers to the assets a company intends to sell in the normal course of business, has in production for future sales, or uses currently in production of goods to be sold. So, three things that constitute inventory. One is items that are brought in for normal sale in the course of business, and these usually refer to retail companies, those who buy just to turn around and sell to others. It also refers to products that are in production for future sale, as I said. And finally, it's the items that are used in the production of those goods for sale. Cost of goods sold is the expense related to inventory. So company has inventory, and when it sells something from that inventory, the cost or the expense associated is recorded in cost of goods sold. Let's break down types of inventory. One is manufacturing inventory, and the other is merchandising inventory. The first point of what makes up an inventory as being the items that are to be sold in the normal course of business apply to merchandising inventory. These goods are purchased primarily in finished form, and the cost of the merchandise that is recorded in inventory is the purchase price plus any order cost that is necessary to get the goods in condition and location for sale. I'll expand on that in a minute, but it's a very important distinction. So not just the cost of purchasing the goods, but also all associated costs to get it from the supplier down to the location and get it into condition where it's ready for sale. Manufacturing inventory, on the other hand, is goods that are produced by a manufacturing company to be sold to a wholesaler, retailers, or other manufacturers or consumers. And they consist of three things. One is raw material, the other is work in process, and then we have finished goods. Raw materials represent the cost of components purchased from a supplier that will become part of a finished good. And a good example is computer chips and computer models that will go into the computer that is produced. So all of those components of raw material form part of inventory. Work in progress in process refers to the products that are not yet complete. And the cost of work in process includes the cost of the materials that go into it once you start it, the cost of the labor that can be directly traced, and the cost of manufacturing overhead. Just the three. So when you have a company that has a plant and an office elsewhere, the overhead from manufacturing at the plant can be billed to inventory, but the one for the headquarters or the office can't. Example of work in process is partially completed components in the assembly line of computers. And then finally, we have finished goods. Cost of goods that have been completed in the manufacturing process but have not yet been sold. Examples include computers produced by HP that are intended for sale to customers. Companies are required to make disclosures about their inventories in the notes to the financial statement. Here is an example of one from Intel Corporation. Manufacturing companies generally disclose either in a note or directly in the balance sheet the dollar amount of each inventory category. So we have raw materials, we have work in process, and we have finished goods for 2016 and 2017 disclosed as a breakup separate from the financial statement in this case. To summarize the slightly more complicated process for a manufacturing company, inventory includes raw materials, direct labor, and manufacturing overhead. Those costs go into work in process, that is part of inventory, and then finally into finished goods. And once those finished goods are sold, then those costs are recorded as expense or cost of revenues in cost of goods sold account. There are two types of inventory systems. One is the perpetual inventory system, and the other is the periodic inventory system. We're going to start with the perpetual inventory system, and this concerns when inventory is recorded or adjusted. Perpetual system continually adjusts the inventory account for each change in inventory caused by purchase, sale, or return of inventory. It continually adjusts the cost of goods sold account each time goods are sold and returned by a customer. It allows management to determine the goods on hand on any date and determine the number of items sold during a period. So with the perpetual inventory system, every time a transaction happens, such as a purchase, sale, or return of an item, immediately they get recorded in the inventory. And whenever an item is sold or returned by a customer, it is recorded in cost of goods sold immediately. Because of the immediacy of the recording, it means that companies know how much inventory they have on hand at a particular point in time. Here is an example of the perpetual inventory system. The Lothridge Wholesale Beverage Company purchases soft drinks from producers and then sells them to retailers. The company begins 2021 with an inventory of 120 at hand, and the following information relates to inventory transactions during 2020. So they begin the year with beginning inventory of 120,000. Additional soft drink inventory is purchased on account at a cost of 600,000. Sales during the year totaled 820,000. The cost of the soft drink sold is 540,000. Lothridge uses the perpetual inventory system to keep track of both inventory cost quantities and inventory cost. The system indicates that the cost of inventory at hand at the end of the year is 180,000. So we start the year with 120,000. We purchased 600,000. That takes the balance in the account up to 720,000. After that, the company sold items with a cost of goods sold of 540,000, and the balance in the inventory account then is 180,000. I don't know if that makes sense to you, but let's see if we can expand on it a little bit in the next slide. So we assume that the beginning balance in inventory of 120,000 is already recorded. Because it's a perpetual system, as transactions occur, we update the system as we go along. So inventory purchased increases inventory by 600,000. It reduces it increases accounts payable by 600,000 as well, because the new inventory was purchased on credit. Next, we record the sales transaction. Sales was made on credit. Accounts receivable is increased, and so is sales revenue. And at the same time, we have to decrease the amount in inventory by cost of goods sold. So cost of goods sold is recorded and inventory is reduced for the same amount. So in summary, the perpetual system records all transactions when they happen, just as it was shown in the example that we've just done. Now, nearly all companies use the perpetual inventory system because it makes things clean. It provides current information about how much of inventory is left over and how much of expenses has been booked. Technological advances reduce the burden of physical record keeping. So companies' point of sale system do the work of adjusting inventory for sales that happen immediately, adjusting for purchases, adjusting for sales, and the like. Automated systems allow for continuous tracking of inventory, for example, barcode scanning or RFIDs. And because of all of these advances, the perpetual inventory system has been simplified, and because of all the benefits that it has, mainly that it helps to keep track of what items you have on hand, you find that most companies, certainly all the large companies, use the perpetual inventory system. Now, the alternative recording system to the perpetual system is the periodic inventory system. The periodic inventory system adjusts the inventory account and records cost of goods sold only at the end of each reporting period. So nothing is reported for inventory and cost of goods sold until the end of each reporting system. It records merchandise purchases and purchase returns and purchase discounts and freight in temporary accounts. So rather than making all of the recordings directly into the inventory account, it keeps all of the records in a temporary purchase account. It determines periodic cost of goods sold by combining the temporary account with the inventory account. So cost of goods sold is the beginning inventory plus net purchases minus cost of inventory. Minus ending inventory. Now let's contrast this with the perpetual system. With the perpetual system, we're not determining cost of goods sold, we are determining ending inventory. Because we have beginning inventory, you can add purchases to that. When sales occur, we start with beginning inventory, we add more to the inventory when we have a net purchase. That new addition of inventory is recorded directly into the inventory account. When sales occur, the expense that support the sales are recorded into cost of goods sold. So the items are removed from inventory and the cost of it moved into cost of goods sold. And then the balance of that is the ending inventory. With the periodic system, though, we are not recording anything for cost of goods sold. We know what beginning inventory is. Maybe a count or some kind of inventory keeping record can help us figure that out. We know what our net purchases is. And then again, we do a nice quick count at the end to find out what the ending inventory is. Beginning inventory plus net purchases tells us the goods at hand. You minus the inventory that you have at the end, and that gives you the cost of goods sold. Here is an example of Lothridge with Lothridge Wholesale, this time with the periodic system. The Lothridge Wholesale Beverage Company purchases soft drinks from producers and then sells them to retailers. The company begins 2021 with inventory of 120,000 on hand. The following information relates to inventory transactions during 2021. 1. Additional soft drinks in the inventory is purchased on account at the cost of 600,000. Sales for the year, all on account, totaled 820,000. Notice the glaring absence of cost of goods sold. When sales occurred, there was no recording for cost of goods sold. Lothridge uses the periodic inventory system. After a physical count of inventory at the end of the year, the ending inventory is determined to be 180,000. The following summary journal entries record the inventory transactions for the company. So first we start with purchases. Instead of recording purchases in inventory, as we would do with the perpetual system, we're using the temporary purchase account. So purchases, accounts payable is credited for 600,000 because we bought it on credit. Here we had sales. We record sales same as we did before. Accounts revenue is increased and so is sales revenue. No entry is recorded for the cost of inventory. And then we decide what inventory is. Start with 120,000 beginning inventory. Then add net purchases. That gives you 720,000 for items available for sale. So pay attention more to this side of that sentence. Items available for sale is 720,000. Ending inventory is 180,000. That means what we sold is 540,000. So a review. We start at the end of the period when all is said and done. Then the company will record cost of goods sold as well as balance out the inventory account. So we have cost of goods sold is increased because it's an expense with a debit, increased by 540,000. The ending inventory account is 180,000. Then we record for credit the beginning inventory amount and the purchases during the year. So the credit side for our purchases during the year and the other side for cost of goods sold and ending inventory amount. Both of these equal each other. Now that we know what the perpetual and the periodic inventory system is, let's compare the two. We'll start with the perpetual system. Cost of goods available for sale is allocated by decreasing inventory and increasing cost of goods sold each time goods is sold. The key word here is perpetual. Every time goods is sold, the inventory account is edited and cost of goods sold is also edited. With periodic inventory system, it allocates the cost of goods sold or cost of goods available for sale between ending inventory and cost of goods available at the end of the period. To do this, it takes beginning inventory amount, adds new purchases to it, and at the end of the period, when it knows how much inventory is left, it then determines how much goods have been sold. Point 2, perpetual inventory system facilitates the preparation of interim financial statements by providing fairly accurate information without the necessity of a physical count. If you go back to how things are recorded when they happen, especially when you're using a point of sale system, it does give a fairly accurate picture of how many items were sold, how many is left on hand without having to do a physical inventory count, which means that you can prepare interim financial statements pretty easily. Now, There is a caveat here, something that we haven't considered, because it treats the items that have not been sold as if they are in inventory. I'm sure if you think about it, you can imagine a scenario where just because the system says we have it, doesn't mean we have it. I know that I've been to stores before to buy items where they have told me that they have it available, and someone goes to look in the back of the store only to come back and tell me that the item that they thought was available is no longer available. So when we say that it provides accurate information, it kind of makes some assumption here that there is no spoilage and there is no theft. So let's hold on to that. With the perpetual inventory system, it requires a physical count before ending inventory and cost of goods sold can be determined. This makes the preparation of interim financial statements more costly. Again, we know how much items we have available for sale because we've recorded new purchases in the purchase account. We know how much was in inventory at the end of the period. So at the beginning of the period, that gives us all the items available for sale. When you do a count of inventory, you know how much inventory is left, and we make this assumption that if you have an item that was available at the beginning of the year or that was purchased during the year, if it's not in inventory at the end of the year, it must have been sold. Again, if this is a company that suffers from inventory theft, it's going to have a real high amount for cost of goods sold, and it would also have no way of tracking inventory theft. So it is what it is. Periodic system makes it more difficult to prepare interim financial statements because you physically have to do a count of inventory at the end of the period. Perpetual system is more expensive to implement, mostly because of the technology that is required to keep track of all of the items in inventory. Small company, maybe not big technology, but if you're a company like Walmart, you have to have RFIDs and other types of electronic systems, barcodes in place that makes it easy to scan items and track items and check it in and out of inventory. Perpetual system, less costly to implement. For the same reason. And then finally, it involves the tracking of both. Perpetual inventory system involves the tracking of both inventory cost, quantities and cost, whereas the periodic inventory system, you can only monitor inventory. You are not recording anything for costs until the end of the period. Example, the Golson Company uses the periodic inventory system. Information for 2021 is as follows. Sales is given, beginning inventory, purchase returns, and ending inventory. What is the cost of goods sold for the year? Let's start with items that are available for sale. Beginning inventory is $340,000. You add new purchases to it. We totally ignore sales because we're not tracking cost of goods sold. It's not relevant for the calculation here. So we've got inventory plus purchases. That gives you the items that are available for sales. At the end of the period, $6,000 worth of items was returned. So it is part of inventory. We minus returns and we minus ending inventory. And that tells us how much goods is available for sale. Another way of thinking about this is we start the year with $340,000 in inventory. We add $600,000. That gives us available for sale. You minus the $370,000 left in inventory at the end of the period. That gives us cost of goods sold. But if $6,000 worth of items was returned, we have $6,000 more in cost of goods sold than we should. So you minus the $6,000 worth of inventory and you are sorted. Here's another example for the periodic inventory system, although you should note that in this example, if we had used perpetual system, there would have been no difference in the numbers. So just an FYI. The Golson Company uses the periodic inventory system. Here is the information given. What is the ending inventory here? We know well, I'll pick the right answer first and then show you the steps. Here we know that the beginning inventory is 640 plus new purchases minus return minus ending inventory gives us the cost of goods sold of 564,000. Therefore, we can solve this equation for the unknown, which is the ending inventory, and that kind of gives us 370,000. So far, we've looked at the costs that are capitalized in inventory for retail firms and also for merchandising firms and also for manufacturing firms. We also looked at inventory recording system that has to do with the accounts that purchases and inventories and things are recorded in and when cost of goods sold is recorded. So we have two, perpetual and periodic. Now we're looking at the physical items that are included in inventory, not the cost, but the physical items of inventory. Items in possession of the company, those are recorded as part of inventory. Goods that are in transit. Now, this is mostly goods in transit from the company to the customer. If the company has a deal where control of the goods and services pass to customers after they receive it, not when it's in transit, then those goods and services are part of the company's inventory. If we are talking about goods that are coming from their suppliers, so not goods going to customers, we're talking about goods coming from suppliers. Again, it depends on when the company assumes ownership. So usually goods in transit, if ownership of the goods pass from supplier to company when it is sent in transit, then those goods and services are included. Goods on consignment, those are part of inventory as well, because what is a consignment? A consignment is when the company assigns goods to a consignee that gets a commission when it's sold. Until that item is sold, it is part of the inventory of the company. And then anticipated sales returns, not just actual sales return, but anticipated sales return are also included as part of inventory. So breaking down goods in transit, it refers to a situation where the goods are on their way to their destination between the supplier and the company, or between the company and its customers. And accounting for goods in transit depends on ownership of goods. Here's an example. In December 2021, the Lothridge Wholesale Beverage Company sold goods to the Jabbar Company. The goods were shipped from Lothridge on December 29th, but did not arrive at Jabbar until January 3rd, 2020. If goods are shipped FOB shipping point, freight on board. So there are two of them. One is shipping point and the other is destination. If they are shipped FOB shipping point, then the title passes on to the customer at shipping point. And if they are shipped FOB destination, the title and therefore control passes to the customer at the destination. So let's start with FOB shipping point. Title transfers at the shipping point. Lothridge records the sale on December 29, 2021, when they shipped the goods. Jabbar includes these goods in its 2021 ending inventory, even though the company has not physically received the goods as of the last day of 2021. That's what it's telling you. The products belong to Jabbar as soon as it is shipped. Now, if the goods are shipped FOB destination, then the title only transfers when it gets to the destination. That means that the goods up until the time it arrives at Jabbar on the 3rd belongs to Lothridge, and therefore Lothridge will record inventory in 2021 And Jabbar will not record any inventory until it actually gets the goods in 2022, which means the item will be part of Jabbar's 2022 inventory. Example, Barrington Corporation uses the periodic inventory system. At December 31, 2021, the end of the company's fiscal year, a physical count of inventory revealed an ending inventory balance of 80,000. So 80,000 physical count. The other items are in transit or somewhere else. The question is, what should the ending inventory be given all this information? So let's sort it out. First, we counted $80,000 worth of physical inventory. Whatever we start with, it would include the $80,000. Merchandise was shipped to customers, FOB destination. It was shipped on the 28th. It didn't arrive until the 5th of January. It doesn't belong to the customer until January, so the 3,000 is part of Barrington's inventory. Merchandise was shipped to customer, FOB shipping. Again, take note of the shipping in this situation. At the point where it is shipped, it belongs to the customer. So merchandise shipped to customer, 12/29. That is no longer part of Barrington's inventory. It is part of the customer's inventory for the year. Merchandise purchased from supplier. Now this is to customer. Now we're talking from supplier. It was shipped FOB destination. Now supplier, keyword, FOB destination, keyword. In this instance, the item does not belong to Barrington until it arrives at Barrington's, and that's not until January 2020. So the company should record 83,000 as its ending inventory count. Here is a breakdown of how we treat goods on consignment. The consignor transfers the goods to the consignee, and even though the consignee has physical control of the goods, it still belongs to the consignor. If a buyer is not found, the goods are returned. If the buyer is found, the consignee gets a commission, and the company takes the item out of their inventory and books part of it as cost of goods sold and books sales revenue at the same time. So goods held on consignment are included in inventory of the consignor until they are sold, and sales is recorded by consignor only when the goods are sold and the title passes on to the third party. So the consignee is an agent of the consignor who retains ownership and control until a buyer is found. Suppose Platt Clothing ships merchandise to Regal outlets. The arrangement specifies that Regal will attempt to sell the merchandise, and in return, Pratt will pay Regal a 10% sales commission on any merchandise sold. Any inventory not sold within 6 months will be returned to Pratt. Regal obtains physical possession of the inventory and has responsibility to sell it, but Pratt retains the legal title. For sales return, when a customer returns merchandise to the company, the item is effectively unsold. And what that means is the cost of goods sold expenses, that returned item is reversed out of it because it's not sold, it's been returned. And when that happens, that item goes back into inventory. So cost of goods sold is reduced and inventory goes up. Now, that's for items that are actually sold. In addition to those two changes, sales revenue is reduced and accounts receivable is also reduced if the item was purchased on account. Now, in addition to items that were actually returned during the period, the company is required to estimate items that it anticipates will be returned in the future. When that happens, the company has to include in inventory the cost of the merchandise it anticipates will be reduced. We're kind of done with the physical items that are included in inventory. So you know that inventory is not just inventory at hand. It includes goods in transit sometimes. If it's going to customers and its FOB destination, if it hasn't reached the customer, that would be included. If it's coming from the supplier to the company, if it's FOB shipping cost, FOB shipping point, it's part of the company's inventory even when it hasn't reached them. We've talked about that. Then we talked about goods on consignment and the fact that the consignee is an agent of the company. The control of the goods does not pass to the consignee until it's actually been sold, when it then passes on to the third party. So until it is sold, it is part of the inventory of the company. And we also looked at sales returns. Sales returns are part of inventory for the company. Now, if it's a purchase and the company is returning a purchase, then yeah, it's also not part of their inventory, but we are going to look at net purchases right now and talk about the costs that affect net purchases. So we're going back to slide 3 and expanding a little bit more on what we say is the capitalized cost of inventory. What are the costs recorded for inventory? In slide 3, for merchandising company, I specifically said it's the cost of the items purchased and the cost of everything that is required to bring the goods into position, into location, and ready to sell. So let's break that down a little bit more. Cost of inventory includes necessary expenditure, 1, to acquire the inventory, and 2, bring it to a desired condition and location for sale or for use in the manufacturing process. Now we're going back to slide 3. Common costs include freight charges on incoming goods, insurance during transit, the cost of unloading, unpacking, preparing merchandise for inventory, maybe security, that kind of thing is all going into inventory costs. All the costs that is necessary to bring the item to location in the desired condition. Purchase return and purchase discounts reduce the cost of net purchases, which therefore reduces inventory costs. So net purchase, the cost that is capitalized is total purchases plus freight and other costs minus all items returned as well as discounts given. Now, for freight in on purchases, if we're using a perpetual inventory system, all of the costs is part of inventory and is recorded in the inventory account. In a periodic system, we use 2 temporary accounts called a temporary account, and it can either be called freight in or transportation in. Now, freight in is just that. The cost to get the item to the desired location in the desired state is included as part of inventory amount. So the cost of shipping items out, not part of it. Shipping items out means we're shipping items to customers. So freight out, there's nothing called freight out, but okay. Freight out is not part of inventory. Those costs are not part of inventory. They're treated as part of cost of goods sold. or as an operating expense. If it's not recorded in cost of goods sold, then the amount incurred is, and the classification of the amount is disclosed in the notes to the financial statement. A buyer views a purchase return as a reduction of purchase. So if you buy something worth $100,000 and you return $10,000 worth of that, it reduces your purchases to $90,000. In a perpetual inventory system, purchases are added directly to inventory, and because that is the case, when you have a purchase return, we reduce inventory. If the item was initially purchased on account, we also reduce accounts payable. If it was purchased for cash, then we get a cash refund that increases the cash account. In a periodic system, though, we use a bunch of temporary accounts. I think that's the moral of the story. With a periodic system, we put all our values in a bunch of temporary accounts, and purchase returns is no different. We use a purchase returns account to accumulate the amount of returns. The purchase returns are then subtracted from the total purchases to calculate net purchases. Next, let's talk about purchase discounts. Purchase discounts reduce your total purchases when you're trying to get net purchases. So net purchase is actual purchase minus purchase returns minus purchase discounts. It reduces the amount. So here's an example. Purchase discounts represent reduction in the amount to be paid by the buyer if remittance is made within a designated period of time. The notation is 210 net 30. 2/10, N30 means a 2% discount if paid within 10 days, otherwise full payment within 30 days. It is the same methodology we use when we're talking about receivables. If you give your customers a discount, you can use the 210 net 30 discount notation. So it's exactly the same thing, except this time the company is the receiver and the supplier is given the discount. Again, we can record the amount either as gross method or net method. On October 5, Lothridge purchased 20,000 of inventory and is offered a discount of 2% for any amount paid within 10 days. The full invoice is due within 30 days. Again, this is a notation, 210 net 30. Lothridge uses a perpetual inventory system, so all the changes go straight into the inventory account. With the gross method, the company purchased the inventory. They purchased it, so they increased their inventory account with a debit of 20,000 for the full amount, and accounts payable by 20,000 because they owe the full amount. The net method, though, treats the 2% discount as if it is already taken. If you have a 100% purchase with a 2% discount, that means you're only paying 98% of the cost of it. 20,000 times 98% gives you the net amount. So we treat the full discount on the day of the transaction at the full amount as if we take the discount on the whole amount. So back up, gross method records the full $20,000 as if there was no discount offered, and the net method records 98%, 19,600, as if we have taken the full discount offered. Now, what happens when the company takes advantage of the purchase discount? Well, under the gross amount, the full amount was recorded as if they didn't take advantage of the discount. But remember that discounts reduce they reduce the inventory balance, right? So if the company took the full discount, then the cost that is recorded in inventory should be the full net amount if they took the full discount. Considering if they don't, though, whatever amount of discount that the company takes advantage of should be recorded in inventory. It should reduce the cost of inventory. So let's use an example of where the company takes a partial discount. The company pays off $14,000 within 10 days, so it gets the 2% discount or the $14,000 for an inventory cost of $13,720. Under the net method, the company recorded the full amount as if it didn't take a discount. So understand that at the time, we're talking about the perpetual inventory system. At the time, inventory was increased by $14,000 plus the extra $6,000. Inventory was increased by $20,000, and accounts payable was increased by $20,000. The company paid $13,000 to settle a $14,000 recorded amount, right? So first things first, because we use the gross method, accounts payable has to go down by $14,000. We were owing $20,000. We've paid $13,720, and that settles $14,000 out of what we owe. So now we should only be owing $6,000, and that's the first entry here. The company records the $14,000 as a debit to accounts payable. Remember, accounts payable can be reduced with debits. At the same time, the easy part of this transaction is the cash payment it makes. It's paying the cash out, so we have a credit to the cash account. And because it's taking advantage of a 280 discount in this case, we have to reduce inventory by 280,000. The net method is a little bit straightforward for the portion where the discount was taken. We recorded the inventory net of the discount when we did the net method. So when we pay $13,720, it reduces our accounts payable by the same amount. Now, what happens with the balance that is paid after the period? Well, the remaining $6,000 in this case does not enjoy the benefits of a discount. With the gross method, we recorded the account as if we didn't take any discounts. When we paid off the $14,000 balance, we have $6,000 left, good to go. Now, the net method is the one that's a little bit more dicey here. We recorded $5,880 as accounts payable using the net method, but because we didn't take advantage, we didn't pay during the discount period, we actually owe the suppliers $6,000. So what do we consider the $6,000 as? Purchase discount lost. So we record accounts payable and record the extra $120,000 difference as accounts payable loss, so that the $6,000 cash paid is balanced with an offsetting debit transaction. Example, Covington Mattress buys mattresses from Simpson's Manufacturing. Covington purchased mattresses from Simpsons on August 16 and received an invoice for $12,000 with payment terms of $210 net $30. Covington uses the net method to record purchases. Covington should record the purchase at, we're talking net method. If we're using net method, we record the amount as if we take advantage of the discount. So we get 2% discount. And if we take 2% discount, that means that we will be paying 98% of 12,000, which gives us 11,760. If they use the gross method, then there is no calculations to be made. We treat the whole amount as if no discounts was offered or received. Therefore, we will record the full $12,000 as the amount. Uh, Here's an example. The Lothridge Wholesale Beverage Company purchases soft drinks from producers and then sells them to retailers. The company began the year with merchandise inventory of 120 on hand. During the year, additional inventory transactions include purchases of merchandise on account that totaled $620,000 with terms 210 net 30. Freight charges paid was $16,000. Merchandise with a cost of $20,000 was returned to suppliers. All purchases on account were paid within the discount period, so the company took full advantage of the discount. Sales on account totaled $830,000. The cost of soft drinks was $50,000, so we have costs. The inventory remaining on hand at the end of the year totaled $174,000. The above transactions are recorded in summary form according to both the perpetual and periodic inventory system using the gross method. Okay. Here is the first instance. Inventory for perpetual system is recorded for the purchases and accounts payable is credited. With the periodic system, accounts payable is also credited, except we record the purchases in a purchase account rather than directly to inventory. 2, freight. Inventory is debited for the cost of freight and cash is credited. Again, the cash accounts are equal, but this time you are putting the cost of freight in. With the returns, account payable is reduced and inventory is also credited, which reduces the inventory account. With the periodic system, same thing. Payables is debited, but instead of inventory, purchase returns is credited. And for the discounts, the company records using the gross method, but it took all of the discounts that were given. So we can say to start with, accounts payable is debited because the company paid cash. So cash account is credited in both cases. And where inventory is credited for the perpetual system, purchase discounts is credited for the periodic system. So these are those transactions put side by side. You can see with the perpetual system, every time a transaction occurs, we are immediately recording it to the inventory account every single time. With the periodic system, we don't record inventory until the end when we do a physical count of inventory, and we don't record cost of goods sold as we go along. We use a bunch of temporary accounts. We use purchase account, freight in account, accounts payable, freight in account, purchase returns, and purchase discount, all temporary accounts which are closed at the end of the period. With regards to cost of goods sold, with the perpetual system, whenever a transaction occurs, we record it to sales account, and accounts receivable or cash account, depending on how it's paid for. With a perpetual system, we record cost of goods sold and the change in inventory at the time of the transaction. With periodic system, notable missing is the entry for cost of goods sold or for inventory, because that does not happen. We get total cost of goods sold only at the end of the period. At the end of the period, there's no entry necessary for the perpetual system, but have a look here. For the periodic system, we do all our recordings for cost of goods sold. ending inventory, beginning inventory, purchase return, purchase discount, and freight in. The credits accounts that have to do with inventory, and the debits, cost of goods sold, and the state of inventory at the end. In this video, we did three things. We looked at the overview of inventory, looked at what constitutes inventory costs for a merchandising company, that is the actual cost of the items and the cost to bring it to location in its desired form, ready for sale. That includes costs of freight in, insurance while in transportation, security, and the like. All of those costs are recorded as part of inventory costs. For a manufacturing company as well, same thing. All the costs to bring the item to a location is recorded. Raw materials are also recorded as inventory, work in process, as well as finished goods. We talked about inventory recording system. There are two: perpetual inventory system and periodic inventory system. The perpetual inventory system is continuously makes changes to the inventory account and to cost of goods sold as we are transacting or as we're going about the ordinary course of business. Whereas the periodic system records all of the purchases that occur during the period in a temporary account, and at the end of the period, it uses the ending physical inventory available to determine how much the cost of goods sold is. Basically, perpetual system, continuous flow of information. Periodic system, updating happens at the end. With the perpetual system, because information is continuous, it means that the company knows how much inventory or what items of inventory is at hand at any period in time, whereas with the perpetual system, with the periodic system, they don't. With the perpetual system, because companies know how much inventory they have at hand at any point in time, it means that they can prepare financial information directly, interim financial documents directly without having to do any physical inventory counts. With perpetual, you have to do the physical inventory counts. So those are the types of information. Now, finally, we also talked about physical items in inventory. Physical items of inventory, not the cost of inventory, but physical items. What items do you count as part of inventory? What items are included in inventory for a firm? Now, we talked about the fact that the items the company has a hold of is part of inventory, of course. Items on consignment is part of inventory. We also talked about the fact that items that are being shipped, it depends. If it's in transit, it depends on whether it is FOB shipping or FOB destination. It depends on whether we are shipping to our customers or our suppliers are shipping to us. And all of that information helps us determine if we should include that item as part of inventory. And physical items that should also be in inventory are items that are returned by customers or we anticipate will be returned by customers. So we will continue this conversation in class. Thank you very much. Have a good rest of your day.